ICT has such a large following because his trading concepts flat out work. And not only for him, but his students have seen the market in a whole new light. They've gone on to pass funding challenges and are enjoying successful trading careers. ICT has hundreds of hours of videos on his channel where he explains advanced concepts like order blocks, fair value gaps, Judas swings, silver bullets, kill zones, and market structure shifts. I know I've been guilty of finding a strategy and only focusing on that one thing instead of seeing how that piece integrates with the whole puzzle. In future videos, I'll go over all of those concepts. But what I want to do in this video is zoom out and look at ICT from a 30,000 foot view. In the next few minutes, we're going to touch on 3 key ICT concepts. Retail traders like to talk about Elliott waves, supply and demand, and harmonic patterns. According to ICT, these are all distractions. One of the most important ideas is to understand what actually moves the market. Forex is the largest and most liquid market in the world. As you can see, it dwarfs the futures and stock markets. Retail traders like you and me don't move the market. Someone buys 10 lots and they're long $1 million. It's like dropping a grain of sand into a swimming pool. You'd be lucky to see any kind of ripple at all. Make no mistake about it. This market is controlled by banks and hedge funds with the weight of billions of dollars behind them. They're like an elephant in a kiddie pool. It's virtually impossible for them to make a move and not leave a trail of evidence behind them. Let's say there's an institution looking to move $1 billion. What do you think would happen if they just market bought 10,000 lots? There'd be massive slippage as they soaked up every order. No, a bank's not in the business of losing money. They're more clever than that. Some would say smart money manipulates price. They'd simply call it engineering liquidity. We're going to the charts now. Pay close attention to how retail versus institutional players view the market. All of ICT teachings are based on this one concept. Without understanding this one idea, nothing ICT says will make sense. Here we're on the 15-minute time frame for GBP US dollar. We have 3 groups of traders. Group 1 is retail traders who think the market is going up. Group 2 is retail traders who think the market is going down. And Group 3 are the institutional traders who actually move the market where they want it. For the sake of argument, Group 1 sees this as an area of support. Price retraces right into this level and Group 1 sees the level being honored, so they start to accumulate a long position. Price looks like it's making a higher low, and by the time we get here, Group 1 has a total long position of 3,500 lots. Group 2 has the opposite view of Group 1. For the last week, they've observed nothing but lower highs and lower lows. On every break of support lower and every pullback, they've added to their short position. By the time we get here, retail Group 2 is short 2,000 lots. At this point, JP Morgan becomes interested and shorts 2,000 lots. As the recent lows are broken, Retail 1 exits 1,200 of their longs. For Group 2, more breakout traders come into the market and short another 1,000 lots. Now Group 1 is long 2,300, Group 2 is short 3,000, and JP Morgan is short 2,000. R2 is in a shorting frenzy as price dips below the recent lows. They short another 2,000 units, but this time it's JP Morgan who's on the other side of the trade. Group 1 is still long 2,300, Group 2 is now short 5,000, and JP Morgan is flat, neither long or short, but already making a profit, They sold here and they bought it back here. It's most likely all of the Group 1 long retail traders had their stop below the recent lows. When price dips below, their stop loss orders automatically become sell orders. JP Morgan is waiting, and as Group 1 sells 2,300 lots, JP Morgan buys all 2,300 lots. At the same time, Group 2 has sell stop orders in case price dips below the recent lows. They automatically add 3,000 lots to their position. JP Morgan is happy to buy these 3,000 lots as well. We know Group 2 is short 8,000 lots, and if you had to guess, where do you think their stop losses would be? There will be some above this recent high, more clustered around these highs, and a few stubborn people will have a large stop loss all the way up here. And since Group 2 is short, they'll have to buy at these prices. JP Morgan is long 5,000 units, and in order to get out of its position, it has to sell. So that's what we mean by counterparty. The buys of Group 2 will be matched to the sells of JP Morgan. A few candles later, the first stop loss is hit. Group 1 is forced to buy 1,500 units, and JP Morgan is the one to sell it to them. JP Morgan bought low and is starting to sell higher for a profit. They have 3,800 units left. The next stop loss is tagged. Group 2 buys 1,500 more lots, and JP sells 1,500 lots for an even higher profit. All of these stop losses being hit triggers price even higher as Group 2 is forced to buy higher as their buy orders get triggered. JP Morgan is selling everything that's available all the way up. They unload their 2,300 lots, but Group 2 has resting stop loss orders of 5,000. So in one candle, JP Morgan goes from being long 2,300 to flat, and now they're short 2,700 lots at the very top of the market. At this point, Group 1 is kicking themselves for getting out when their stop loss was hit before. They knew price was going higher and they were right. A group of breakout traders in Group 1 decide to get long 4,000 lots, and JP Morgan is right there to sell it to them. If you had to guess, where do you think Group 1 would have their stop loss? These are the three most likely levels, and if we know it, don't you think JP Morgan knows it too? These stop loss orders are sell orders, which is exactly what JP needs. Because since it's short, it'll need to buy long. JP Morgan sold at the top and now just bought back 1,000 lots for a profit when Group 1's first stop loss order was hit. JP Morgan just bought back another 1,000 lots on the next stop loss. JP Morgan closes out 2,000 more lots after Group 1 closes the entire position. JP is still short 2,700. As price is obviously moving lower, Group 2 is getting itchy and starts to enter breakout trades to the short side. What do you think JP Morgan is doing as retail is selling at lower and lower prices? You can be pretty confident that JP Morgan has cashed in by now. Retail is still selling, and now JP Morgan is long. By this time, JP Morgan is net long 5,000 lots. Price seems to have stabilized. Now retail traders are either getting stopped out of their short positions or they're entering into fresh long breakout trades. You can be sure JP Morgan knows where these pools of liquidity are and is likely to start selling at a profit. This cycle happens over and over again. Smart money accumulates a large position. They trap retail and other hedge funds on the wrong side. They know where the liquidity is. They're arresting stop loss orders and people waiting to take the breakout. There's no point in complaining about market manipulation. If you can't beat them, join them. Our job as traders is simply to get involved with what the smart money is doing. We want to be buying when retail is selling and selling when retail is buying. The way to do this is not to find a magic indicator. We want to look for telltale signs of the fingerprints in the chart that smart money leaves behind. Now, the big question is how to identify and take advantage of these patterns. ICT has three concepts that go together: power of three, Judas swing, and kill zones. We'll dive into far greater detail on these three in future videos, but let's quickly look at the first two. The power of three looks at the daily candle. When there's a large bullish day, it's common for price to actually start lower before it makes its true intention known. Price moves up, retraces a little, and closes near the high of the day. The same is true for bearish candles. Price often fakes to the upside before moving south and closing near the low of the day. A Judas swing is what we just saw in the charts. Think of Judas from the Bible. What was he known for? He was characterized by manipulation and deception. This is exactly what institutional players are trying to do to us retail traders. The Judas swing is where price moves beyond a significant support or resistance level. Stop loss orders are triggered and breakout traders join the action. The devious part is, once everyone's offsides, price quickly retraces in the opposite direction and catches everyone off guard. ICT's kill zone concept says these events are not random. In fact, there's a small window of time every day when these Judas swings are most likely to happen. According to this, Forex trades an incredible $6.6 trillion a day, but us retail traders only make up 5.5% of the volume. In fact, 5 businesses account for 40% of the global Forex market. These banks and institutions are based in New York and London, and this is when the heavy volume comes in. Before I mention that while Forex is a 24-hour market, there are certain times of the day that are better. The best times to trade are the London and New York sessions.
Feeling bewildered and like the game is rigged. And you just learned that it is rigged. And there's a means of understanding how it's rigged. Let's look at these specific times when price moved. Early London Open or Frankfurt. This is New York Open. The very beginning of New York Open. This is Asia. This is London Close. And this is London Close as well. So you can see there are specific turning points that are occurring at session open and closings.
Let's go back to the charts and see a couple examples of the Judas swing in action. The Judas swing describes a pattern that often sees price breaking the high or the low of the Asian session in the wrong direction before continuing in the opposite. I'm using one of the ICT kill zone indicators, and these are the time settings. Marking out the highs and the lows of the Asia session, we wait to see which is hit first. The yellow box is the start of the London kill zone. Many times price will break in the opposite direction of the real move. So for example, here London moves higher. It may entice more long breakout traders to enter. Smart money is taking the opposite side of the trade and accumulating short positions. Notice the high of the day occurred during the London kill zone and the low occurred during the New York kill zone. This isn't a coincidence. Here's another example of the Judas swing in action. The Asian session just ended and we mark the highs and lows. Traders who are long will have their stop loss below this low. This level is triggered and these stop loss orders turn into sell orders. The big players who pushed price lower are now buying at a lower price. Once the big banks get in for cheap, price rapidly moves higher during the New York kill zone. It's true that Forex trades 24 hours, but there are certain times that are better than others. The New York and London Open are ideal for day trading. You'll have a huge advantage if you're able to trade during these specific kill zones. This is when the market is most likely to make the high or the low of the day. However, knowing this Judas swing or any of the other patterns ICT teaches comes with a caveat. You can't just jump down to a 5-minute chart of the London or New York Open and be oblivious to everything else. He teaches to only take trades that also line up with other factors. These could be support and resistance levels, significant highs or lows, or valid levels on the higher time frames.
Write this down and underline it several times. You do not look for a trade or a trading pattern on your intraday charts unless it is trading at a higher time frame support resistance level, okay, or at a higher time frame reaction level. That means the trade has to be formulated and framed around a level that you had already arrived at from the daily and or 4-hour time frame.
If I had to summarize the one key ICT message, it would be to think about where stop loss and breakout orders are resting right now. A trade can only take place if there's a willing buyer and a willing seller. Institutional players are mainly concerned with making a profit by looking for these counterparties. They move price from level to level, seeking out this liquidity. To be better prepared to implement ICT's methods, I have a whole video on support and resistance, how to identify it, even a couple good indicators that can automatically do the work for you. Click here to check it out. As you dive deeper into ICT, you'll learn more and more about setups to look for. You don't want to be like retail traders who chase price, but that's only half the battle. You must be disciplined enough to wait for the trade to come to you. Not only is ICT one of the most technically sound traders that I know of, but I think he has such a large following because he doesn't sugarcoat anything. He tells you the truth, no matter how unpleasant it might be. Day trading doesn't mean winning every day or even taking a trade every day. Long-term winners are more concerned with the process of developing instead of worrying about tomorrow's results.
And like I said, it's hard to do that without just getting in there and desensitizing yourself to the point where you just don't care if the outcome is going to be profitable or not, because that's what it takes to be consistent. You're not worrying about the end result. You just trust the process of what you're doing. Eventually, over time, the sample sizes are more weighted on the positive side of what you're expecting to see than that of the temporary and sometimes, unwanted negative results. That is missing the trade or getting stopped out.
ICT is far from a perfect system. You'll make money over the long run, but don't be surprised if next week your setup fails and you take a loss or two. How you respond to losses will make all the difference in the world. Losing money naturally triggers an emotional response. The urge is to lash out at people around us or revenge trade, try to prove the market wrong. Your mindset and risk management will either make or break you in this game.
every trader is going to have to encounter a losing trade. As a new trader, especially if you start with live funds, you're trying to avoid this like the plague. Generally, it's a good idea to try not to lose money, but you can't avoid it. It's going to happen. It's an absolute. You're going to run into a brick wall and money will be withdrawn from your account. You need to be able to have a frame of mind and a procedure on how you're going to encounter and engage and overcome that obstacle. Equally so, every trader will experience a series of losing trades. Now, this is where that wave of emotion comes in, and you feel regretful. You wish you wouldn't have done certain things. Certain emotions will trigger a response that may result in anger, lash out at your computer, family, your spouse, your children, your dog. Don't do that. Procedures that you need to have in place, what you're going to do to, number one, control the bleeding, stop losing money, slow it down, and then eventually look to mitigate it. But you can't come back from massive losses if you don't first identify what you're doing wrong and stop doing that very thing.
In future videos, we'll get into the ICT risk management strategy and how he sizes up or down depending on the winning or losing streak. We'll also explore how he enters trades, trails a stop, and takes his profit. But for now, start to develop the mindset of a winning trader. Learn about risk management and emotional control by clicking the video here. Thanks for subscribing, and I'll talk to you soon.